Welcome to this video on what is inflation. Inflation is a term that we hear a lot in discussions about the economy, but it can be a confusing and often misunderstood concept. In this video, we will explore what inflation is, what causes it, and how it affects us in our daily lives. Understanding inflation is crucial for making informed financial decisions and navigating the complex world of economics. So, let's dive in and learn more about inflation. Have you ever noticed that prices seem to keep going up and up? From groceries to gas, it feels like everything costs more than it used to. This phenomenon is called inflation, and it's a natural part of any economy. But what exactly is inflation, and how does it affect us? Inflation is a term used to describe the rate at which the general price level of goods and services in an economy rises over time. In other words, it is the rate at which the purchasing power of a currency declines. Inflation can be measured in several ways, including the Consumer Price Index and the Producer Price Index. Inflation occurs when there is an increase in the amount of money in circulation, and the supply of goods and services does not increase at the same rate. When there is too much money chasing too few goods, the prices of those goods increase. This increase in prices reduces the purchasing power of the currency, which means that consumers can buy fewer goods and services with the same amount of money. There are two main types of inflation: demand pull inflation and cost push inflation. Demand pull inflation occurs when there is a high demand for goods and services, and the supply cannot keep up. As a result, the prices of goods and services increase. Cost push inflation occurs when the cost of production increases, and businesses pass these costs on to consumers in the form of higher prices. Inflation can have a significant impact on an economy. If inflation is high, it can reduce the standard of living of consumers, particularly those on fixed incomes. High inflation can also reduce the competitiveness of an economy, as the prices of goods and services become more expensive compared to other countries. Additionally, inflation can cause uncertainty and instability in financial markets. Governments and central banks often try to control inflation through monetary policy. This can involve adjusting interest rates, controlling the money supply, or implementing other measures designed to influence the level of inflation. Inflation targeting is a popular approach used by many central banks, where a target inflation rate is set and policies are implemented to keep inflation within that range. In conclusion, inflation is a rise in the general price level of goods and services in an economy, which reduces the purchasing power of a currency. It can be caused by a variety of factors and can have significant economic impacts. Governments and central banks use various policies to try to control inflation and keep it within a manageable range. But what causes inflation? There are a few different factors that can contribute, but one of the most significant is an increase in the money supply. When a government or central bank prints more money, there is more currency in circulation, but the value of each individual unit decreases. Another factor that can contribute to inflation is a shortage of goods and services. When demand is higher than supply, prices tend to rise. This can happen when there is a disruption in the supply chain, such as a natural disaster or a labor strike. Inflation is a sustained increase in the general price level of goods and services in an economy over a period of time. There are various factors that can cause inflation, including 1. Money supply. One of the primary causes of inflation is an increase in the money supply. When the central bank prints more money or lowers interest rates to encourage borrowing, more money is available to consumers and businesses, leading to an increase in demand for goods and services. However, if the supply of goods and services does not increase at the same rate as the money supply, prices will rise. 2. Cost push inflation. Cost push inflation occurs when the costs of production increase, and producers are forced to increase prices to maintain their profit margins. Examples of factors that can cause cost push inflation include an increase in the cost of raw materials, energy prices, or wages. 3. Demand pull inflation. Demand pull inflation occurs when there is an increase in demand for goods and services that exceeds the supply. This can be caused by factors such as an increase in consumer confidence, government spending, or a rise in exports. 4. Exchange rates. A change in exchange rates can also cause inflation. If the value of a country's currency decreases relative to other currencies, the cost of imports will increase, which can lead to inflation. Similarly, a rise in the value of a country's currency can reduce the cost of imports and decrease inflation. 5. Expectations. Inflation expectations can also play a role in driving inflation. If consumers and businesses expect prices to rise in the future, they may adjust their behavior by increasing spending and wages, which can cause inflation to occur. 6. Supply shock. A sudden disruption in the supply of goods and services can also cause inflation. For example, a natural disaster that destroys crops or disrupts supply chains can lead to a shortage of goods, which can increase prices. In summary, inflation can be caused by a variety of factors, including an increase in the money supply, rising production costs, excess demand, changes in exchange rates, inflation expectations, and supply shocks. Understanding these factors can help policymakers develop effective strategies for controlling inflation and promoting economic stability. Finally, inflation can also be influenced by investor confidence and the overall state of the economy. When investors are optimistic about the future, they are more likely to invest, which can stimulate growth and increase prices. Conversely, when there is uncertainty or instability in the economy, prices may fall. So why does inflation matter? Well, it can have a big impact on our daily lives. When prices rise faster than our income, it can be harder to make ends meet. It can also reduce the value of our savings and investments over time. To illustrate this point, let's say that you have $100 in your bank account, and the inflation rate is 2%. If you leave that money in the bank for a year, its value will have decreased to $98 in terms of purchasing power. In other words, you can buy less with that money than you could a year ago. Of course, there are ways to mitigate the effects of inflation, such as investing in assets that are likely to appreciate in value or adjusting your budget to account for rising prices. Central banks also try to control inflation through measures such as adjusting interest rates and managing the money supply. In conclusion, inflation is a natural part of any economy, and it refers to the rate at which prices for goods and services are rising, while the purchasing power of currency is decreasing. Inflation can be caused by a variety of factors, including an increase in the money supply, shortages of goods and services, and investor confidence. Its effects can be felt in our daily lives, from the cost of groceries to the value of our savings and investments. However, understanding inflation and its causes can help us make better financial decisions and adapt to changing economic conditions. Thank you for watching, and I hope this video has helped you understand the complex concept of inflation a little better. Don't forget to subscribe to our channel for more informative videos on economics and finance.